Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, we're talking about technical analysis, which is kind of like the dark arts of investing. And whereas there is some legitimate use to technical analysis, and it's a phenomenon that does actually kind of exist in the markets, it's not something that we need to pay that much attention to as ordinary everyday investors. That being said, I'm seeing a lot of young people being seduced by technical analysis-based videos on YouTube and TikTok, and it's a little dangerous, and I wanted to comment about my thoughts on technical analysis and its place in the investment process in today's show. So I hope it's interesting, and I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So on the show today, I would like to talk a little bit about technical analysis. Technical analysis, I don't know what number episode we're on, but it's got to be in the 160s. We've covered a lot of stuff on the show. It's been a great pleasure of mine to be able to host it and have some cool guests on and communicate using this podcasting medium. I really get a kick out of this. I hope all you listeners out there do as well. And I sense that that's the case because we have more and more people listening to the podcast. But before I get too far off track here, of all the stuff that we've covered, I don't think we've ever talked about technical analysis. And I wanted to bring this up in today's episode because there seems to be a growing number of young people who are interested in investing because they're interested in technical analysis, or maybe their attraction to investing is focused on technical analysis. And it could be that they're watching like YouTube or TikTok videos or something like that, where the source of their information and where they're learning may not be that fundamentally sound. But at any rate, there seems to be an increase in interest in technical analysis recently over the last couple of years. So what the heck am I talking about, technical analysis? I'm talking about the charts, moving averages, head and shoulders tops, head and shoulders bottoms, crosses. Technical analysis is the idea of making an investing or trading decision based on recent stock price movements, as opposed to fundamental analysis, where you make an investment decision based on the underlying fundamentals of that company. And so the best way to think about technical analysis, in my opinion, is it's kind of like, it's almost like the dark arts of investing. There is a little bit of genuine, sincere activity. There is a little bit of accuracy to technical analysis, right? There is legitimacy. That's the word I'm looking for. Thank you. There's a little bit of legitimacy to technical analysis, but I think people often mistake that as, I think they often misprioritize it. And rather than making an investment decision based on longer term objectives through a sound and prudent and robust process, they're throwing money at different stocks because of the charts. And that is totally backwards. So here's an example of technical analysis. Here's why it does have some legitimacy. Let's start with moving averages, like 50 and 200-day moving averages. If you take a look at Google Finance, or you log into your brokerage account and you look at any chart for any stock, and you look at the performance over the last year, you might be able to superimpose on that graphic what's called a moving average. 50 or 200 days are the two most common moving averages. And the thought is that those moving averages, which are just the average price, average opening or closing price over that time period, 50 or 200 days, is a resistance point, meaning that if the 200-day moving average is higher than where the stock is trading right now, that if the price of the stock you're looking at approaches that moving average, there is going to be some kind of force in the market that creates resistance and prevents the price of that stock from breaking across the moving average and trading above what that long-term average is. So it's this force in the market, right, that doesn't really have any rhyme or reason to it from one angle, because stocks should trade based on their intrinsic value of future cash flows, based on the merits of that investment as a company. They should not trade based on some chart, right? And this resistance, it's almost like the Force in Star Wars. It puts pressure on stocks in one direction or another, and a lot of traders and a lot of investors make decisions based on that information. Now, the theory goes, if you're heading toward a moving average, to put more, maybe let's elaborate on our example a little bit further. Let's say the 200-day moving average for a stock is $100 a share, and the stock's trading at $80 a share. And then they have an earnings announcement that's positive, and the price goes from 80 to 85 to 90 to 95 to 97. Well, if you're a believer in technical analysis, the basics of technical analysis, you might expect that stock price to hit some resistance. And you might think that it's less likely it's going to continue increasing because it's bumping right up there against that moving average, and you might expect it to fall below $100 or $97 a share as a result of that resistance. But if if it is able to break through that threshold, and all of a sudden you wake up and it's trading at $102 a share, the technical analysis theory will tell us that it has some momentum and room to run, and therefore we might want to purchase that stock because it's got some momentum behind it and will likely continue running. And that resistance can be the opposite too. Let's say it's trading at $150 a share, and its moving average over a 200-day period is $125 a share. Well, we might expect it, if it falls in price closer to $125 a share, we might expect it to kind of skip off that moving average. But if it gets enough momentum and breaks through, then it will continue falling somewhat rapidly. Now, that's the idea behind this stuff. So does that impose any kind of comment on the merits of that investment, the merits of the company, or what their product looks like, or what their market share or return on assets look like, or cash flow? None whatsoever. It's just simply looking at this chart, which is completely removed from the merits of that company. Now, this is kind of a self-reinforcing prophecy, though. And I say that this is why it's a little bit, it does have some legitimacy to it, is that on the one hand, these charts, these resistance points that we're talking about, have nothing to do with the underlying company. Yet they still kind of exist, and there are these pressures. And the reason is that there are a lot of people, a lot of traders out there in the market who believe that this phenomenon is real. And if you're in the situation where the price is approaching, it's the price of your stock is $80 a share, it's climbing toward the moving average, which is $100 a share. If you get to $97, $98 a share, the traders in the market who believe in this stuff are going to sell because they expect it to bounce off that moving average and then fall in price thereafter. So they're going to sell because they believe in the phenomenon. So guess what happens? When more people sell, when it's hitting that threshold of $97, $98, $99 a share, that's going to put downward pressure on the stock. And so even though this has absolutely nothing to do with the fundamental merits of any company or any stock investment, it still exists because people out there believe in it, because it's been around for a while and there are enough people trading based on that information that it actually creates that kind of pressure on the upside or the downside of some of these stocks. So it's an interesting thing. I pay hardly any I pay zero attention to technical analysis in my work in the firm unless somebody has a huge position in one company and we need to be cognizant of those pressures going up or down, because it's going to have a dramatic impact on their financial situation if some kind of technical pressure is going to show its ugly head at a convenient or inconvenient time. That's something that we ought to know about. So I am somewhat versed in this, but I very, very rarely use it because that situation just doesn't come into our firm very frequently. Now, this other phenomenon of a lot of, especially young people, becoming interested in investing is great. It's really cool, I think, but they're reversing the priority of how and when we should pay attention to technical analysis. And so some other examples that might ring a bell that you've heard of in the past, we're talking about moving averages. There are all sorts of names that people have to signify or explain some kind of upward or downward pressure. Head and shoulders is a big one. Crosses, single, double, triple crosses. I heard one time somebody called it like the triple death cross or something like that. And I'm sure that it's a hyperbolic term that's meant to sell advertising and screen time and just get more people to pay attention to it. But sometimes that phenomenon actually does have explanatory power, because if enough people believe it, then it's just naturally going to come true. So while there is some merit to this, what I think is dangerous is choosing securities based on technical analysis only. Okay, so I gave the example. If somebody comes into our firm and they have a huge position in company stock. Well, we ought to pay attention to the charts, and we ought to understand the technical pressures that are relevant to that position, because we're probably going to want to trade out of it and diversify a little bit at some point. But that position already exists. That person already has those shares, and that's probably because they've worked at the corporation for a long time. Maybe they were paid in company stock. The issue I have is people coming into an investment portfolio. They have cash in their account. They're trying to decide what to buy, and they're making that decision first based on some kind of technical analysis. That is silly and stupid. Often I will be reluctant to use terms that blatant, but that's just flat stupid. A better way to do it is to take what's called a top-down approach. On the fundamental side of investing, so we talked about technical analysis, the alternative is a more fundamental approach. Some people like top-down, other people like bottom-up. Either way works. In a bottom-up approach, you're looking at a whole bunch of different companies and then trying to evaluate which of those companies is going to perform the best going forward. I think it's very challenging to do that successfully, is the nicest way to put it. I think it's darn near impossible, the way information passes around the universe these days. A top-down approach is starting at, well, what do we want our high-level asset allocation to be? So if we want 80% of our accounts in stocks, we want 15% in bonds, and we want 5% in other stuff like investment real estate. That's a top-down approach. And when people way smarter than me have studied this and tried to evaluate, well, is a bottom-up approach going to lead you to more investment success and better outcomes, or is a top-down approach better for investors long-term? What they found is that over 90% of the returns you're ever going to get in your portfolio are a direct result of your asset allocation, which tells me that it's way more important to decide whether you want to hold stocks or bonds than it is whether you want to buy like Nike or Adidas or Ford or GM or Lowe's or Home Depot. those decisions have far less impact than the aggregate asset allocation that you have across your portfolio. So because that's going to have a far more dramatic impact on the returns in your portfolio, makes sense that that's where we ought to start, right? So how do you determine what your asset allocation should be? Capacity and willingness to take risk is a big one. When are you going to need to use the money that you are investing? If you're younger and you're saving for retirement, then you have a long time horizon. You have the capacity to take a lot of risk. If you're saving some money in a bank account and you want to buy a house in a couple of years and you're not sure if you should invest that or not, well, you don't have the same capacity to take risks because you're going to need it in a couple of years. Maybe you have a lot of natural comfort with swings in your portfolio value. Maybe you don't. Well, that has bearing on how much risk you should take and has bearing on your asset allocation. But at the core of it, when you start out investing, it's important to just do some kind of discovery exercises and explore what you're really trying to accomplish. Is this money that you're putting into the 401k that you plan to take out in 18 years when you hit your full retirement age or when your pension kicks in, or some other factor? Is this something that you're going to need sooner than that? Why are you investing this? Is this just a couple $1,000 that you came into because you got a scratch off lottery ticket hit when you went to the grocery store last week and you just want to play the ponies? Well, that's a pretty good example of having capacity to risk it all and do something like crypto or invest it all in a single security. The whole idea is you have to identify why you're investing in the first place and what your capacity for risk is to zero in on what that asset allocation ought to be. And at its highest level, that's the breakdown you got to start with. How much do you want in stocks? How much do you want in bonds? How much do you want in cash? How much do you want in other stuff? Real estate, alternatives like private credit, maybe business development companies. There's commodities. There's a whole bunch of examples of that. The next decision you have to make is the next level down with regard to asset class. So if you want 80% in stocks, now your next decision is, what kind of stocks do I want? Do I want them all in the US? Do I want some in developing or emerging markets? Do I want Chinese exposure or do I want to omit that? Do I want big companies? Do I want small companies? Do I want growth or value? That's the next decision down. But again, the decision of investing in stocks in the first place is far more impactful than whether you're going to invest in big companies or small companies, because they're relatively correlated. Same goes for U.S. or non-U.S. That's more those two subcategories are more correlated than stocks and bonds are. So this is the top-down approach. And for those of you just listening, I'm making some hand gestures here where my hand's at the top. This is the area we make that decision of stocks, bonds, cash, and other stuff. The next tier down, now we make the decision of how much is going to be in U.S. versus non-U.S., emerging versus developed markets, big companies, small companies, value, growth. On the bond side, then what kind of issuers are we going to include in our bond portfolio? Will there be inflation-protected securities? Will we have issuers from other countries, or will everything be denominated in US dollars? Those kinds of decisions. And then at the bottom, the third level is, all right, so now we've established high-level asset allocation. We know how much we want to allocate to all these other categories. Now we're actually going to decide what securities to purchase. And so a really popular way to do that is index funds, and index funds work great. That's the decision of how you're going to build the portfolio pursuant to how much you want in your asset allocation across all these categories. So it starts broadly, stocks, bonds, cash, other stuff, then subcategories, and then you pick your securities. And the fourth level down is location. Location meaning what accounts are you going to park these investments in? Because at the end of the day, your household portfolio is what matters. We shouldn't be looking at, how is account number 1 doing compared to account number 2. None of that really matters. What matters more is how is your aggregate household portfolio doing? Because the asset allocation there is going to be a big determinant of your household wealth. Again, based on the research of how much of your return is a direct result of that one really big decision that you have to make. That being said, most of us in this country who are investing in stocks have several options of where to park those investments. If you open an account in your name or in the name of your trust, that's going to be taxable. You might have a 401k or an IRA that's tax deferred, or a Roth IRA that's tax exempt. Well, there is some strategy here. And in general, you want to put the least tax efficient, highest growth asset classes in the Roth IRA, because that's the account you're never going to pay tax on again. And the most efficient asset classes in your taxable account. And an example of that is maybe large cap U.S. growth stocks, because those are the companies, if you hang on to them for a long time and you have capital gains are taxed as less than income. But if you have bonds in that account that pay you interest, that interest is taxed at your ordinary income rate. So there is some strategy behind where we place each of these asset classes. And if we are going to pay attention to technical analysis at all, technical analysis should come into play when it comes time to actually build the portfolio. After you already know, what is my asset allocation, how much am I going to allocate to each of these subcategories, and what securities am I going to buy in which account. Technical analysis, because it doesn't fundamentally make sense, but yet it does exist, the phenomenon is legitimate in the markets, we can pay attention to it and make trading decisions off of that. And if you've made the decision that you are going to invest in 327 different companies to comprise your stock allocation, well, the timing of when you get into those could be informed by technical analysis. You could look at them all, and if it looks like, based on that analysis, they have some room to run and some momentum behind them because of whatever chart you're looking at, well, those are the first securities that you'd want to purchase. But if it looks like any others are bumping up against some kind of resistance level, they might be more likely to be pushed down in value, and you might want to wait around until that happens so you can purchase them at a lower price. But back to what I see happening more and more frequently is people are looking for investment ideas and opportunities by evaluating the charts without regard to what their core objectives are and what their overall asset allocation is. They have it completely backwards, and that's not going to lead you to a very good outcome long term. So I think it's really cool that young people are becoming interested in investing. Social media is a crazy place. There are a lot of really good, legitimate educators on social media, but man, there's a lot of hocus pocus and snake oil salesmen too. And I'm just concerned that a lot of young people are going to be led down a dangerous path where they put the cart before the horse and get out over their skis with regard to how much risk they're taking, because they never really evaluated what they're investing the money for or what their capacity to take risk is. And that really has to happen first. So that's mostly what I wanted to cover on the show today. I hope this was halfway interesting. Technical analysis is really an interesting thing. And again, it exists. Those pressures do impact stock prices, but for the vast majority of investors, the reason that we like to use the capital markets to grow wealth over time is because it gives you an avenue to invest in some of the best companies in the world that are incentivized to create and deliver products and services for profit that benefits their clients and their customers and adds value and takes in revenue, and after all the corporation's expenses has profit left over. Our whole capitalistic system, and the reason that this checks and balance system works so well, is that mechanism is true. And technical analysis ignores all that. It just looks at something completely unrelated to the profitability and profit making power of a specific company. And by engaging in that system And just being involved in that structure of the board is elected by the shareholders, the board oversees the CEO is responsible for driving revenue and profits, and the shareholders are entitled to those profits. That's the checks and balances system that we want to participate in, because that's what's going to lead to the returns. It's not because of the moving averages look fortuitous or you've got a triple death cross coming up on one of your holdings. That's ancillary to the whole problem. All right, so I've probably expounded on this enough, but for those of you who have kids who are interested in this kind of stuff, good on you for getting them interested in it. Good on them for becoming interested in it. But I would strongly urge anyone to just put the technical analysis stuff in the back seat and start with the fundamentals first. And then when you're actually making the buying and selling decisions of the stuff you already know you want to hold, that's when the technicalities come in. All right, that's it for today. Hope this was helpful, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.